The biggest investment lesson of my life was not how to pick stocks. It was not how to read a balance sheet. It was not even how to estimate intrinsic value. Those things matter. I built my whole life around them. But the deepest lesson came earlier and cut much closer to the bone. Most businesses die, not because the founders are stupid, not because the managers are lazy, not because the products are always bad. They die because the economics underneath them are weak, and time is ruthless with weak economics. That is the truth almost nobody wants to hear when they first enter the market. They want a formula. They want a checklist. They want a ticker symbol. They want the feeling that if they learn enough accounting and enough valuation language, they will be able to identify the winners and simply hold them forever. I understand the appeal of that dream. The market would be much easier if durability were common. It is not. Durability is rare. Most companies are temporary arrangements pretending to be permanent institutions. They look strong in one decade and strangely fragile in the next. I watched it happen to businesses that once looked immortal. People used to speak of IBM with the kind of certainty usually reserved for mountains. Kodak built one of the most recognized names in corporate history and still discovered that inventing part of the future does not guarantee you will own the future. The market buries yesterday's champions with remarkable efficiency. That is why I never wanted to own businesses merely because they looked strong in the present. I wanted businesses whose economic character made them hard to dislodge. That distinction became clear to me when I was very young. My grandfather, Ernest Buffett, ran a grocery store in Omaha. He was a stern, serious man, not given to sentimental speeches or educational theater. He believed in work, not performance. When I was young, I worked in that store, and a grocery store is a magnificent place to study the hard realities of business, because everything people say abstractly about competition becomes visible on shelves and price tags. One afternoon, I saw a man walk in whom my grandfather knew well. He owned another grocery store in town. He was dressed decently enough, not flashy, not broken. He looked like a man the world might describe as respectable and established. But he stood in front of the flower section for too long. That is the sort of detail an old merchant notices. He compared bags carefully, far more carefully than an ordinary household shopper would have. In the end, he bought one bag and left with a kind of expression that tries to hide worry and usually fails. After he walked out, my grandfather said something cold and simple. "That man is finished." I asked him what he meant. He told me that a grocer who has to come into another grocer's store and inspect flower prices like that is usually not shopping. He is bleeding. He is trying to understand why the customers are leaving and why his own economics no longer work. My grandfather said something else I never forgot. He told me that a bad business often looks respectable right up until the moment the economics finally force it to confess. A few weeks later, that grocer's store closed. What happened? Nothing dramatic. No scandal. No grand betrayal. A chain store had opened nearby with lower prices, broader selection, and better operating scale. The man was trapped. If he matched the lower prices, he lost money. If he held his prices, he lost customers. His problem was not bad luck. His problem was that he was standing inside an industry with no real moat. That was one of the first genuine business lessons of my life. A company with no moat runs naked. It may appear healthy for years. Then one change in price, one stronger competitor, one shift in distribution, one new format, one technological improvement, and suddenly all the pleasant assumptions disappear. That is why I never trusted businesses simply because they were familiar or looked busy. Restaurants can be wonderful places to eat and terrible places to own. Retail can be exciting for shoppers and brutal for shareholders. Commodity manufacturing can look productive and still destroy capital for decades. Many small businesses work hard every day simply to remain vulnerable. I did not want that life as an investor. I wanted industries where the economics themselves worked in my favor. Charlie helped sharpen this understanding in me over many years, but the instinct began early. We did not want businesses that won only if management remained superhuman forever. We wanted businesses that had structural advantages, businesses where time deepened the moat instead of eroding it. Over the decades, I came to believe there are a handful of industries built not merely on temporary fashion, but on enduring facts of human nature and physical reality that matters. Because human nature changes slowly, and physical reality changes slowly too, tastes shift, interfaces shift, delivery mechanisms shift, but fear remains, trust remains. The need to move goods remains, the need for power remains, the desire for reliable value remains. That is why I keep returning to 5 kinds of business. Not because no other industry can ever produce good returns, many can. But these 5 are unusually durable because they are anchored in needs that do not evaporate when the market mood changes. The first is insurance. The second is branded consumer products. The third is essential infrastructure. The fourth is utilities. The fifth is membership retail built on trust. If you understand why those 5 endure, you understand something much larger than stock picking. You understand the shape of economic permanence. Let me begin with insurance because almost no one gets it right when they first look at it. Insurance does not look glamorous. That has always pleased me. The market loves bright objects. Insurance is not bright, it is clerical, it is statistical. It sounds slow, procedural, and unromantic. That is often an advantage. Industries that do not flatter the ego are frequently the easiest places to find rational economics because fewer people are trying to turn them into theater. Wall Street long treated insurance as a sleepy business. I never saw it that way. Insurance is built on one of the most permanent forces in all of human behavior, fear of uncertainty. As long as people love their families, as long as they own homes, drive cars, run businesses, worry about accidents, fear illness, or simply prefer not to be financially ruined by one unlucky event, insurance will be needed. That is not a trend. That is part of the human condition. The average observer thinks insurance companies make money by collecting premiums and then paying less in claims than they took in. Sometimes that is true. A disciplined underwriter can absolutely make money that way. But the real genius of a good insurance company lies somewhere deeper afloat. That single word transformed Berkshire Hathaway. It transformed how Charlie and I saw the world. If someone pays an insurance premium today and the claim is not paid until much later, the insurer holds the money in between. That money is not profit in the simple accounting sense. It may eventually be needed to pay claims. But in the meantime, it is capital under the insurer's control if underwriting is disciplined. That capital may cost the insurer very little, or in the best cases, nothing at all. Try to appreciate what that means. Imagine a business where customers hand you billions of dollars first, and you get to invest that money before you may need to send any of it back out. There are not many businesses on earth like that. It is as if the world lends you money in advance because it is afraid of uncertainty. And if you are a careful allocator of capital, that float becomes a magnificent engine. When I first became involved with Geico, what attracted me was not excitement. It was clarity, the model was elegant, sell directly, keep costs low, insure sensible drivers, stay disciplined, generate float, invest intelligently. Repeat for decades. Many people underestimate how hard discipline is in insurance. The industry itself proves this repeatedly. Foolish managers chase volume. They underprice risk. They want market share. They convince themselves that doing more business is automatically good business. It is not in insurance. Bad volume can be poisonous. A smart insurer would rather write less business at sensible terms than more business at foolish terms. That is why Geico mattered so much to me. Discipline turned premiums into valuable float instead of dangerous promises. And over time, that float became enormous. Berkshire's insurance operations have generated more than $160 billion of float. People throw numbers around casually, but think about what that means. It is like having a gigantic pool of investable capital built on the very ordinary fact that human beings want protection from uncertainty. That is a moat, not because no one else can sell insurance. Many can. The moat comes from discipline, scale, brand trust, underwriting culture, and the ability to invest float intelligently over very long periods. A weak insurer can destroy itself. A strong insurer can become a compounding machine. That is why I never worried much about whether insurance looked sexy. I cared that it would still matter when the next sexy industry had become yesterday. S story, the same logic applies to life insurance, auto insurance, reinsurance, and many other corners of the field. The exact products differ. The underlying force is the same. Fear, prudence, and risk transfer are not going out of style. The richer society becomes, the more there is to insure, the more complex life becomes, the more protection people seek. Insurance is not merely stable because it is boring. It is stable because it sits on top of permanent human vulnerability. That is a very solid place to stand. The second enduring category is branded consumer products. This is one of the most misunderstood moats in the world because lazy people think a brand is just advertising. It is not. A real brand is a shortcut in the consumer's mind. It is a reduction of uncertainty. It is permission to stop thinking. That is worth an enormous amount. Charlie used to push me hard to think beyond accounting book value and toward intangibles that did not show up cleanly on the balance sheet. One of the greatest examples in our lives was C.S. candies. When Charlie first pressed me toward C.S., I resisted. The numbers on paper did not flatter the price. The book value looked light relative to what we would have to pay. The old Ben Graham reflex in me did not enjoy that. Charlie kept pressing. He understood something I was slower to fully absorb. A great consumer business with pricing power could be much better than a statistically cheap business with no real loyalty. We bought C.S., and in time it taught me one of the most valuable investment lessons of my life. People were not buying only candy, they were buying certainty. That may sound poetic, but it is economic truth. A man buying a box of C.S. for Valentine's Day is not simply optimizing sugar per ounce. He wants to know the gesture will land correctly. He wants the other person's face to brighten. He wants the gift to carry a signal of quality and affection. That confidence is worth paying for. And if consumers willingly pay for that confidence year after year, then the business has pricing power. Pricing power is one of the finest assets in capitalism. See, S could raise prices without losing the customer relationship that made the business special. It did not need endless capital investment to preserve that. It did not need to conquer every geography on earth to justify itself. It merely needed to maintain the trust and emotional recognition it already owned in the minds of customers who cared. That is why I stopped thinking of brands as decoration. A strong brand is a moat because it reduces friction and decision, making when someone reaches for Coca-Cola, he is not conducting a scientific experiment. He already knows what it tastes like. He knows what the red can means. He knows the experience. That certainty has been planted over generations. It is not simply market share. It is mental real estate. When we bought Coca-Cola stock in the late 1980s, we were not buying a syrup formula. We were buying one of the strongest positions in the consumer mind ever created. People all over the world did not just recognize Coca-Cola. They trusted the experience. That is very difficult to replicate. And that is why I've always said that if someone handed me $100 billion and asked me to build another Coca-Cola from scratch, I would not know how to do it in any reliable way. You can buy advertising. You cannot buy a century of accepted certainty overnight. That is what a brand gives you. The ability to earn without having to reintroduce yourself every day. I saw the same principle in other contexts too. Take a tool company like Bosch. A contractor using a drill on a job site does not care only about the sticker price. He cares whether the tool will fail when failure is costly. The same is true for many trusted industrial or household brands. In theory, a cheap substitute may exist in practice. The user often chooses certainty over small savings. That is what the outsider misses. He says consumers are price sensitive, sometimes they are, but consumers are also risk sensitive, time sensitive, embarrassment sensitive, and effort sensitive. A trusted brand reduces all of those frictions at once. That is why I believe branded consumer products remain one of the most durable categories in the world. Not every brand, certainly not. Many so-called brands are weak costumes. I mean the real ones, the ones that simplify choice, the ones that own a category or a feeling, the ones that people reach for automatically because the decision feels settled before it even begins. Those brands can endure for generations. The third category is essential infrastructure. This one is powerful for a completely different reason. Insurance is about fear. Brands are about certainty. Infrastructure is about necessity plus enormous barriers to entry. If you own part of the physical system through which society must move goods, information, power, or resources, you are standing in a very unusual place. I do not mean every infrastructure asset is wonderful, but the category contains some of the clearest examples of natural moats in capitalism. Railroads are a beautiful case. When Berkshire bought BNSF, a lot of people thought it looked old-fashioned. A railroad, how quaint. That is the sort of reaction you often want from the crowd before you buy something truly valuable. They were thinking about image. I was thinking about economics. Try building a railroad network across the western half of the United States from scratch. The capital needed would be staggering. The regulatory process would be suffocating. The land, the rights, the physical complexity, the time, the politics, the duplication of an already existing network. All of it makes the thought almost absurd. That is the point. Some assets are valuable precisely because the modern world has become too complicated and too expensive to reproduce them. Railroads move tremendous amounts of freight with extraordinary fuel efficiency compared with trucks. They connect ports, farms, industrial centers, consumer markets, and everything in between. As long as goods need to move, rail matters. And because the network already exists, the incumbent enjoys advantages that are not easy for an outsider to attack with enthusiasm alone. That is what a moat looks like in physical form. The market often gets too intoxicated by software and forgets that real civilization still depends on hard things. Steel, landlines, rails, pipes, grids, terminals, towers. Those things do not usually trend on social media, but they still make the world possible. That is why I love owning part of the physical skeleton of society when the economics are right. It is not fashionable enough for the crowd, and yet the cash flows can be magnificent. Infrastructure of the right kind is protected not merely by reputation or pricing, but by replacement difficulty. That is a very deep moat. The fourth category is utilities. This one teaches a lesson the public does not always enjoy hearing. Competition is not always your friend, at least not if you are the owner. The public often talks as though competition were morally beautiful in every context. In consumer terms, that may be true often enough. In shareholder terms, it depends entirely on what side of the competitive structure you are standing on. A utility is one of the clearest examples of a business where monopoly-like conditions can be enormously beneficial. Not because the business can behave recklessly, it usually cannot. Utilities are regulated, their returns are supervised, the public must be protected from abuse. But that regulatory structure often protects the incumbent too. If you live in a given territory, you generally do not choose among 4 electric grids. You do not switch water systems the way you switch brands of cereal. You are served by one network. That network required gigantic capital outlays. It is politically protected, operationally embedded, and structurally indispensable. This creates a particular kind of business, not hypergrowth, not glamour, not astonishing margins. Something much more useful: predictable demand, stable economics, allowed returns on invested capital, a recurring relationship with society that does not depend on being trendy. That is a wonderful thing. Berkshire Hathaway Energy grew into a major earnings engine because utility economics, when managed sensibly, can be very powerful. The public hears regulated returns and imagines limitation. I hear regulated returns and often think stability. If you can deploy capital into infrastructure the world must have, and regulators allow you to earn a fair return over time, you have something quite valuable. You have a business that can keep compounding without asking the world to rediscover it every 5 years. And utilities are not becoming less relevant. The world is becoming more electric, more digital, more power hungry, more computationally intense. Data centers need energy. Electrification needs grid investment. Transmission expansion will not happen by wishful thinking. Storage, generation, and distribution all matter. That means the utility and power infrastructure world still stands on the right side of necessity. Again, the crowd may prefer stories with more fireworks. I prefer the businesses that will still be standing after the fireworks burn out. The fifth category is membership retail built on trust. This is a subtle moat, which is why I like it so much. At first glance, retail seems like exactly the kind of industry I warned against earlier. Low switching costs, constant competition, price pressure, thin margins. That is all true in ordinary retail. Costco is not ordinary retail. Costco is a trust machine disguised as a warehouse. When I first studied Costco closely, what impressed me was not simply low prices. Lots of retailers advertise low prices. What impressed me was discipline. Jim Sinegal understood something that far too many retailers never learn. If you want long-term customer trust, you cannot squeeze every transaction for every available dollar. You must voluntarily leave something on the table so the customer begins to believe at a visceral level that you are on his side. That is a moat Costco. S model is elegant. Charge a membership fee up front, earn a large portion of the economics there. Then run the merchandise operation with extraordinary restraint on markup. The customer learns, over repeated experience, that the warehouse is not trying to exploit him. The customer begins trusting the institution. That trust leads to astonishing renewal rates. Renewal rates matter. They tell you whether the relationship is merely transactional or whether it has become habitual and emotional in the right way. If a membership model renews above 90%, you are not just selling goods. You are selling confidence. A customer who renews that reliably is telling you that the store has become part of his mental operating system. He is not walking in suspicious. He is walking in pre-committed. That is deeply valuable, and it creates a beautiful loop. Low margins build trust. Trust builds renewals. Renewals create a dependable fee stream. That scale improves purchasing power. Purchasing power supports lower prices. Lower prices reinforce trust. The loop tightens. Competitors can imitate parts of that model. What they struggle to imitate is the discipline required to keep leaving margin on the table year after year in service of long-term trust. That is why I say trust is one of the deepest moats in commerce. It is difficult to build and easy to damage. Costco built it well. And because people will continue buying household essentials, food and everyday goods in huge volumes, a trusted membership retailer has a type of durability ordinary merchants rarely enjoy. Now, if you step back from these 5 categories, something larger becomes visible. They are not random. They are united by a few deeper principles. Insurance monetizes fear of uncertainty. Branded consumer products monetize certainty and familiarity. Infrastructure monetizes necessity and replacement difficulty. Utilities monetize monopoly, like indispensability under regulation. Membership retail monetizes trust and recurring behavior. Those are all human constants. That is what I mean when I say some industries are more likely to endure than others. I am not claiming every company in those industries will thrive forever. Of course not. There will be bad managers, bad capital allocators, poor cultures, weak balance sheets, foolish acquisitions, overexpansion, and all the usual forms of corporate stupidity. But the category itself begins on stronger ground. That matters because investing is difficult enough already. Why begin in an industry that requires perfection merely to survive? I have never wanted perfection. I have wanted favorable economics. That is a very different thing. Charlie and I used to talk often about the difference between businesses that require constant heroic effort and businesses that can do well, even if managed by people who are merely decent rather than brilliant. That is not because we preferred mediocrity. It is because we respected structure more than personality. The world overpays for charisma. It underpays for sound structure. A weak business with a charismatic leader is still a weak business. A strong business with a durable moat can often survive mediocre leadership far better than people think. That is why I always return to the industry first. What sort of battlefield is this? Are the economics friendly? Can competitors enter easily? Does the product matter enough to the customer? Is there pricing power? Is there switching friction? Is there replacement difficulty? Is trust embedded? Does time deepen the moat or erode it? Those are the questions that matter, because time is the great judge. People ask me often what I would change if I started over. The answer disappoints them. Very little. I would still spend almost all my time trying to identify businesses that time would favor rather than punish. Time is wonderfully unfair. It destroys weak businesses slowly and then all at once. It rewards strong businesses quietly until suddenly the rewards look enormous in hindsight. The difference between those two outcomes is often invisible in the beginning. That is why most people miss it. They are too busy being entertained by novelty. Novelty is one of the market's favorite tricks. A new category appears, a new product appears, a new story arrives. Everybody starts imagining infinite upside. Sometimes there is real upside. Often there is simply excitement. I have never wanted excitement from my core holdings. Excitement is for racetracks and card tables. My fortune was not built by chasing the newest thing with the brightest narrative. It was built by understanding a handful of enduring principles deeply enough to let time work on my behalf. That is the right relationship with time. Many people think investing success comes from motion. I think it comes from correct stillness. Stillness after sound selection. Not lazy stillness, not ignorant stillness. Informed stillness. There is a tremendous difference. Once you own a business with a real moat, the hardest work is often not buying it. The hardest work is sitting there while the world tempts you to do something else. A stock doubles and you feel clever. A stock falls and you feel anxious. A new idea appears and you feel bored. A sector becomes fashionable and you feel late. A bubble forms and you feel stupid for being sensible. All of those feelings push people toward activity. Activity is often the tax people pay for not trusting the work they already did. I preferred to trust the work. I preferred to own things that did not require my daily rescue. A true moat becomes a friend of time. That is one of the loveliest facts in all of finance. Coca-Cola's position in the consumer mind does not weaken because another quarter passes. A utility network does not become easier to replicate because a year goes by. A railroad, right? Upway does not become less valuable because some analyst finds it old. Fashioned an insurer's ability to collect float does not vanish because the market is obsessed with something else this month. Costco's trust relationship with members does not evaporate because a loud retailer tries another promotion. Time can actually deepen these advantages. That is what you want. You want economics that age well. And once you find them, patience becomes rational instead of merely moral. This is also why I never admired trend. Chasing very much, the people who chase trends often confuse speed with intelligence. They think being early in the newest thing is equivalent to being wise. Sometimes it works for a while, sometimes very well, but a lot of that success depends on being right repeatedly in environments where the underlying economics are unstable, the competition is uncertain, the moat is speculative, and the future is being repriced constantly. That is not my preferred game. My preferred game has always been simpler. Find what will still be needed. Find where the moat is real. Find management that will not do anything suicidal. Pay a sensible price. Then wait. People underrate how much wealth has been built by waiting correctly. The world makes it look too easy in hindsight and too boring in real time. That is why so few people do it. They cannot stand the boredom. They need constant proof. They need novelty, narrative, reinforcement. The market is happy to provide all of those things, usually at a terrible price. I preferred to be paid for patience. Patience applied to the wrong business is foolishness. Patience applied to the right business is often genius disguised as inactivity. That is what I learned. There is another thing I learned, and it becomes more obvious the older I get. The best businesses do not simply produce money. They reduce the number of things you need to predict. If I own a weak retailer, I must predict fashion, consumer preferences, competitor pricing, rents, labor, supply chains, and any number of other variables that can ruin me. If I own a great insurer with disciplined underwriting, or a great brand with pricing power, or essential infrastructure, or a regulated utility, or a trust-based membership model. The future is not perfectly predictable. But the number of things that must go exactly right is much smaller. That is enormously valuable. Good investing often means reducing the amount of genius required for success. That may not sound romantic. It is very profitable. And because I am an old man now, I think more about what remains when the noise dies down. People ask about legacy. I do not think much about statues or public praise. What I care about is whether a useful way of thinking survives me. If it does, then perhaps some younger person with no special background, no magical advantage, and no desire to spend his life chasing every new shiny object can still build something durable. That is what I want for them. I want them to understand that there is no need to out-clever the world every year. There is enormous value in simply understanding a few permanent truths. Fear will always exist. Trust will always matter. People will still need power. Goods will still need to move. Consumers will continue paying for certainty. And businesses built around those truths will have a better chance of surviving the long march of time than businesses built mainly around temporary excitement. That does not mean they should be bought at any price. Price always matters. Even the finest business can be a bad investment if you pay too much. But once price is sensible, quality and endurance become the great allies. This is why I tell people not to confuse the market's attention with economic reality. The market may spend years obsessing over what is novel. Economic reality spends decades rewarding what is necessary. I prefer the second timetable. If I were teaching a young investor with no background and no patience for jargon, I would say it this way. Do not ask first which company is hottest. Ask which industry is hardest to kill. Do not ask which product is newest. Ask which need is oldest. Do not ask what everyone is excited about. Ask what people will still be paying for 20 years from now, even after the current excitement has moved elsewhere. That is how you begin finding real moats. And once you find them, guard your own behavior. That is the last piece most people neglect. They may even choose the right businesses. Then they ruin the result by not being able to sit still. They trade too much, they compare too much, they stare at prices too often, they let temporary declines insult them into action. They let temporary gains seduce them into arrogance. They keep interrupting the compounding. They claim to admire. That is one of the most common tragedies in investing. The right asset in the wrong hands can still produce a mediocre result because the hands were too restless. I think my greatest advantage was not that I knew more than everyone else. It was that I trusted a few truths strongly enough to leave them alone. That is a form of peace. And peace is an underrated asset. You cannot compound well if your mind is always on fire. So yes, most businesses die. That is not pessimism. It is hygiene. It clears away the childish belief that every decent company deserves long-term ownership. Most do not. A few industries, and within them a few great businesses, do deserve it. Insurance, when disciplined, because fear and float endure, branded consumer products, when truly trusted because certainty and habit endure, essential infrastructure because physical necessity and network effects endure. Utilities, because society cannot function without power and regulated monopolies endure. Membership retail when governed by trust because reliability and repetition endure. Those 5 categories do not make you rich automatically. Nothing does, but they place you in the right neighborhood and in investing. Being in the right neighborhood matters a great deal. The rest is judgment, price, patience, and behavior. That has always been enough. It is still enough now, and it will still be enough long after the current parade of fashionable certainty has marched on to the next thing. If a young person asked me what single line he should carry for the rest of his life, I might tell him this. Find the moat, then become a friend of time. That is not complicated, it is merely hard. But the world often pays astonishingly well for hard things that remain simple. This is one of them. And if you can do it, if you can really do it, you will discover that the greatest wealth is not merely measured in dollars. It is measured in how little you need the market to entertain you once you know you own what endures. That is freedom. That is investing at its best. and that is the lesson I would most like to leave behind.